Hey, welcome to episode 4. Today is going to be an interesting episode talking about the bank default loans and a prediction I made about 2 years ago when I did some work for an auto refinance company, which I stopped working with them after about a week when I realized what an evil, treacherous industry that is and how it's going to impact the car market and the overall economy. I predicted all that back in 2021 when I saw these auto refinance companies refinancing 4, 5, 6-year-old cars with a brand new 6, 7, 8-year long loan term. Absolutely absurd and ridiculous to save people $100 a month or $1,200 a year for the result of them having a car that's not worth anything. They can't afford to repair it. They owe $5, 6, 8,000, $10,000 on it, and they still have 4, 5, 6 years left in their loan. What are they going to do? They're going to default on their loan. Well, that's happening now. There's a Bankrate.com article that was just written by Rebecca Betterton, and I'm going to talk about that article. I'm going to talk about the prediction that I made, and I'm going to talk about what's going to happen if we don't change some things. So the first most important thing to understand is what is a consumable versus an asset. And you have to understand why a car is a consumable product and it's not an asset. The main reason for that is a consumable product is something that's used or consumed, while an asset is something that retains value and can be used repeatedly. If you think about a car, they all depreciate except in very rare circumstances. But mostly they all depreciate, and while you can repair them and keep it going, it still has a finite life. It can't run forever. It's going to stop. It's going to become too the cost to repair it is not going to be worth the value of the overall vehicle at some point, because you're just going to have to replace everything, and at that point that car's life is over and you throw it out or recycle it or whatever, recycle the parts off it, but you have to replace the car. It's a consumable. And so if you don't understand that, you might make a decision like refinancing a 5-year-old car, which is a terrible idea. Maybe even just buying a 5-year-old car isn't that great of an idea from a financial perspective, unless you have a very specific circumstance where you don't drive a lot or something, or you need a very specific vehicle and it makes sense. But in general, most people shouldn't be buying used cars, and they shouldn't be having a 5-year loan or a 6 or a 7 or an 8-year loan on a 4 or 5 or 6-year-old car. That's absolutely absurd. So the result of all of the bank loans is that the bank defaults are now rising quickly on auto loans, and loans that are 30 days delinquent have increased to 2%, over 2% in the third quarter of 2022, where they were about a half a point less a year earlier. There's a number of factors that have impacted the car market, but let's just get down to the bottom line. Refinancing an auto loan on an older car is a risky move, as the value of the car is likely to have decreased significantly by the time the original loan was taken out. This means the borrower is going to end up owing way more on the car than it's worth, which can increase the likelihood of a default. Additionally, some auto refinance companies may offer loans with higher interest rates or unfavorable terms, which can make it difficult for borrowers to keep up with their payments, even though they're saving $100 a month on their payment. Over time, it's just not going to work out. It's worth mentioning that the prediction of rising bank defaults due to auto refinance companies would depend on many factors, such as the economy, market conditions, and practices specific to companies in question. In general, it's a good idea for borrowers to really consider the terms and conditions of any loan before agreeing to it, and make sure that they understand the longer term risk. You can't just think about that monthly, I'm going to save $100 a month. You have to think about 3 years out or 2 years out or 4 years out when you still have several years left on that loan and that value of that vehicle is next to nothing, and it needs a big repair that maybe you still can't afford even though you're saving $100 a month. So what's coming is that there's going to be an even accelerated increase in bank defaults on car loans. This is my prediction. And I was right about the bank default happening at this time. So let's see if I'm right about my next prediction, which is there's going to be an increase in bank defaults accelerating in 2023, along with rising inflation, scarcity of cars, scarcity of car parts. It's going to have a very negative impact on the overall economy, especially for lower income and lower credit-worthy people. Bank defaults are going to lead to huge financial losses for banks and lenders, which is going to affect their ability to lend money and invest in the economy. The ripple effect of that is that businesses and individuals are going to have a harder time getting financing they need to invest in their own operations and growth. Consumers won't be able to afford repairs that have on cars that have negative asset to loan value. Banks won't finance huge amounts of negative equity so somebody can get into a new car, especially if they have lower credit, they don't have enough money to put down, that type of thing. And the car market is going to come crashing down in the next year or two. The only way out is to lower new car prices and used car prices as well, even though I'm not a used car purchasing fan for financial reasons. And at the same time, interest rates have to be held low. It doesn't matter if you lower the car price and you skyrocket the interest rate. The consumer pays the same monthly payment, and the bottom line is most people have a car payment. If they have to have a car, they're going to have a car payment, especially in that lower income and lower credit-worthy bracket. That's most of the people that I dealt with in the auto industry as an auto broker. You know, there's a handful of people that come to you that have awesome credit and everything's perfect, and they know what they're doing and they know exactly what they want and they understand everything and they're just all set. And there's a lot of people who come to you who are in a bad situation because of the way they bought the last car, and you're trying to help them buy a car right this time, but maybe they can't wrap their head around the fact that a car is not an asset. It's a consumable product. They can't wrap their head around, what their parents taught them, or, what they learned somewhere along the line, or, some idea that they're holding on to closely. And so they're going to get stuck in a situation paying a higher payment on a less value car with a higher interest rate, until they get on that bandwagon of we need to, do this right financially with a long-term thought and process of, every 3 to 5 years replacing this thing, and ideally the way to go is leasing. One of the other impacts that's going to happen if we don't get this car market right and people can't buy cars, they can't afford cars, they can't get around, is it could span across other parts of culture. Like there could be increased car theft. There could be higher costs for anybody to buy a car or anything related to cars. There could be higher costs to anything related to transportation, which is basically everything. Everything is, on a boat, a plane, a truck, a semi, a smaller vehicle at some point in its life. And make no mistake, if there's limited car parts for consumers, there's limited car parts in the commercial world as well. And so we really need to be thinking more long term about these types of issues, or we're going to have much greater consequences for something simple like an auto refinance industry, which frankly should be as illegal as these check cashing places that offer 20 or 30% loans. It's 20 or 30% a month that people can never afford to get out of. If you have a 4-year-old car or more and you're refinancing it for more than 36 months, you're making a very bad financial decision, and you're going to learn that about 36 months out when the car needs a big repair and it's not worth doing the repair on, and you still have several years left on the loan. Anyway, I'm sad to say that this prediction has come true, but here we are, and it's accelerating. And again, I think things are going to get far, far worse if the auto industry doesn't step up and the banks don't step up and control the prices around cars and help people get out of all these bad auto loans that these auto refinance companies have put them into. Thanks again for watching. Have a great day, and we'll see you next time.